Alright, quick breakdown. How a US government shutdown can affect real estate. I'm framing this as 3 timelines. Short, medium, prolonged because the impacts stack over time. No predictions here, just scenarios to help you plan. Scenario 1. Short shutdown, roughly 1 to 2 weeks. Closings keep moving, but slower. If a loan needs IRS income verification transcripts, those can stall. FHA loans still exist, but staffing limits can delay case numbers, endorsements, or guarantees. VA loans still exist, but staffing limits can delay case numbers, endorsements, or guarantees. USDA loans still exist, but staffing limits can delay case numbers, endorsements, or guarantees. Conventional loans move faster by comparison. If the National Flood Insurance Program lapses, some homes in flood zones can't close until coverage resumes. That's a direct pause button on otherwise ready deals. Appraisals mostly continue, inspections mostly continue, but anything requiring a federal sign-off or database check may queue up. Rates can wobble because key economic data releases get delayed, leaving bond markets guessing. Small moves, big anxiety. Scenario 2. Medium shutdown, about 3 to 8 weeks. Pipeline backlog grows. Underwriting stacks up and a wave of clear to close gets pushed out. Some rate locks expire. Extensions can cost buyers money. VA processing timelines stretch. FHA processing timelines stretch. USDA rural loans face notable delays. First-time buyers relying on these programs feel it most. NFIP lapse becomes a real drag in coastal markets. NFIP lapse becomes a real drag in river markets. Listings sit. Agents juggle addenda and renegotiate timing. REITs and lenders watch volatility. Mortgage-backed securities spreads can widen. Lenders price in more risk, nudging mortgage rates up even if treasuries look calm. Federal workers and contractors miss paychecks, dinging demand at the margin. Leasing inquiries soften near government hubs. Some renters downshift or delay moves. SBA 7A, loan stall. SBA 504 loan stall. That slows small business expansions and hits neighborhood retail and light industrial leasing momentum. Scenario 3. Prolonged shutdown. 2+ months. Confidence takes the bigger hit. Household formation slows. More fall-throughs from expired locks. More fall-throughs from qualification changes. Days on market rise. HUD payments face delays. Section 8 payments face delays. Landlords depending on those payments face cash flow strain, pushing some to tighten screening or pause upgrades. Multifamily sees upticks in delinquencies where federal pay drives local economies. Concessions reappear. Renewal strategies get defensive. Development timelines slip. Environmental reviews get delayed. Permits tied to federal touchpoints get delayed. Tax credit milestones get missed, pushing pro formas off track. CMBS and private lenders reprice risk on hospitality. Hospitality near national parks. Hospitality near federal sites. Hospitality near travel corridors. Short-term rental markets near closed sites soften. If data silence persists, the Fed and markets operate with less visibility. That can mean more rate volatility, impacting cap rates and valuations across asset classes. Bottom line, this isn't about panic, it's about planning. Short, expect friction. Medium, expect bottlenecks and cost creep. Long, expect confidence and credit to rewrite timelines and pricing. If you're buying, build time buffers and know your loan type. If you're selling, prep for addenda and hold your buyer warm. If you're operating, stress test cash flow and debt covenants. I'll keep this updated as facts change. Save this. Share it with your team. Adjust your timeline before the timeline adjusts you.